Welcome to the Alpha Hustle. This is a weekend review of Nifty on 20th Feb. Essentially, we're going to talk about how Nifty auctioned this week, what different time frames are doing, review of overall auction using the market profile charts, and finally the quick review of other technical nuances with potential scenarios that may likely to play out next week. So let's quickly get started. Bulls started off this week on a positive note to hit fresh all-time highs of 15,430, followed by profit booking during the latter half of the week at the back of global cues. Let's look into what different time frames are doing. We're going to take a top-down approach here to review the structures, starting from monthly, followed by weekly, and ending with daily charts. Let's start with the longer-term time frames here. One time framing to the upside is still intact, suggesting longer-term time frame is still interested to the upside. So what does one time framing mean? I often get this question on social media asking like, what exactly does one time framing mean? So Jim Dalton introduced this terminology and uses this quite often. This is nothing but traditional higher high, higher low, or rather lower high, lower low structures. Making higher high or higher low is called one time framing to the upside, while making lower highs and lower lows is called one time framing to the downside. It's a phenomenal V-shaped recovery we have in the charts since April. One time framing to the upside started in the month of June after a breakout from an inside month in May. There is a little pause here during the month of September. However, bulls resumed their rally to the upside ever since with one time framing to the upside by not breaching the lows of the previous months. Market has left a selling tail in the month of January that has been taken out in Feb thanks to the budget. Market clearly is auctioning above the January high. Clearly, the longer term money is still interested in the rally and the trend on longer term time frame is up. Now let's look into what intermediate term time frame is doing. After a pause ahead of the budget 2021, intermediate term time frames are back together with longer term money to head higher. However, there is a change on intermediate term after market formed an outside week, stopping the one time framing to the upside. I wouldn't say that we are in for a big down move as such, given that the longer term time frames are still intact in this bull market. So probably this is just a pause for some pullback to gain some strength and head higher. Next week would give us indication whether we're going to have a follow through or probably take a pause, get some acceptance and head higher. Now on the shorter term time frame, there is a change in the context from buy the breaks to sell the rips. Fresh highs have brought in the responsive sellers to start one time framing to the downside for three continuous sessions in a row with considerable volume expansion. Broader market structure of higher highs or higher lows is not compromised yet. Now let's take a look at the market profile charts. Market opened higher with a gap on 15th of Feb that started an imbalance move out of the 5-day balance. It's pretty much a slow grinding day up. However, bulls have got a very good closing towards the high point of the day. On the 16th of Feb, the bulls had a nice gap too, though the sellers tried to fill the gap and then extend back into the prior day's range. They failed miserably for the buyers to kind of auction higher. However, the buyers are not strong too. The responsive sellers have stopped in around the 15400 zone, and this HVN at 15400 is a very important reference to carry forward. So the exhaustion by the buyers met by the sellers at 15400 led the liquidation of the week longs all the way back to the high end of the prior balance zone. The subsequent days had a very interesting price action. So the market opened back within the lower distribution of 16th of Feb, and the sellers failed in the first instance to get the range extension to the downside that led to a V-shaped recovery, or as Jim Dalton calls, shot in the hole to rally back towards prior day's HVN, where the seller stepped in again to push the prices lower and eventually extend the range on the downside and get a neutral extreme close to the down. A similar price action again back on the 18th of Feb, where the market opened back within the range. Buyers tried to probe higher. However, you know, the seller stepped in right in the C period, with leaving a failed auction extending the range to the downside, forming a double distribution day, again closing the market back within the prior balance. Same story again on the 19th, where buyers have got a weak opening. They tried to probe higher after the sellers failed in the initial A period. However, the buyers failed too, back in the prior day's value area, leaving a failed auction in the C and D periods, and then the sellers extended the range to the downside. So the pattern and the context has literally changed in a very, very short term, from a buy the breaks to the sell the rips. So as you can see, all the rallies into the prior day's value area or POC, the point of control, are being sold into on the 17th of Feb, on the 18th of Feb, and also on the 19th of Feb. Buyers have stepped in below the prior balance low and then kind of pushed the prices back into the balance again. So has the sellers completed their auction to the downside with the responsive buyers stepping in, or is there a follow through to the sellers before the buyers have come in and shut off the selling? But this is something that will be known during the next week's auction. Let's take a look at the upward auction and the important references to the upside. It was nearly a 250-point range on Friday. Open-end acceptance within this range is likely to be choppy. Buyers need to push the prices back into the upper distribution and get acceptance above 15,100 and 15,150 zone to retest the failed auction left in C and D periods. This price action could stop one time framing to the downside and retest of prior high and HVN at 15,200 and 15,250. So this is the HVN we are talking about, which marks the high point of the prior balance as well as a failed auction in the C period. If the buyers are confident enough to take out the zone, they may take a jab at the responsive sellers near the 15,400 zone that led the liquidation. However, it all depends on how confident the buyers are to be able to stop the one time framing to the downside. So the important reference for Monday is primarily the buyers, if they are strong enough to push the prices back above 15,100 and 15,150 zone. That considers that the selling on the downside is complete and the responsive buyers that have stepped in near 14,900 or some strong hand buyers to start one time framing to the upside. All right, now let's look at the important references to the downward auction. Acceptance within the buying tail from Friday confirms that the sellers haven't finished their job yet and gives the odds for a probe of low at 14,900 and continue one time framing to the downside. The next important reference to the downside is 14,766, which is a prior swing high, as well as the 21 DMA. We have got some strong demand below this zone. So any acceptance below this prior swing high of 1476, 766 can be really choppy. However, any acceptance within that zone would mean that the markets are heading for 14,400 and 14,480, which is a gap that has been left after the budget day. So, however, getting acceptance and heading towards a gap would require some really high confidence initiative sellers in the market. Now let's take a look at other important technical nuances that may help us put different pieces of puzzle together. HVN at 14,400 to 14,600 that acted as a resistance during the prior swing will now act as a strong demand to work with. Any pullback towards this zone is a nice buying opportunity in terms of risk reward. In terms of the moving averages, 21 DMA is placed at 14,766, so is the prior swing high. So this makes it an important reference to watch out for. Higher time frame buyers have been protecting 21 DMA as well as the 15 DMA for a few months now. So it'll be interesting to see how they would react coming to the 21 DMA. Cumulative OA suggests that the down move is at the back of shorts being accumulated. So it'll be interesting how the shorts would get the follow through next week, or if the weak hand shorts got to cover in case if there is no follow through. Given the different pieces of puzzle, let's try to put together and build potential scenarios that may likely to play out. Scenario one is basically balancing within the 15,000 and 15,250 zone. Any acceptance within the Friday's buying tail of 14,984 and 14,900 going to bring in more sellers and continue the auction to the downside. Any acceptance below 14,900 is likely to head for a probe of 14,766, which is a prior swing high, as well as the 21 DMA. Rejection of the buying tail would mean that the buyers are strong enough to push the shorts for cover, which is basically going to push the prices back towards the HVN of 15,250 and 15,260. Any acceptance above this zone is likely to probe the responsive sellers at 15,400 and 15,430 that led the liquidation. Any rejection around 15,250 and 15,260 zone is going to likely to push for the retest of the strength of buyers below 15,000. So in summary, higher time frame trend is still intact, while in the shorter term, the sellers have been selling on every rise. 14,766 is an important reference to watch on the downside, while getting back above 15,250, bulls could take the control back and head for fresh highs. So always remember to trade with the trend and keep your risks under control. Thank you for joining and listening to us. Happy trading.